Let's talk about the US economy, a machine that's lately started sputtering and coughing instead of chugging along. Recent economic data has been a roller coaster. One moment recovery whispers, the next headlines that make you want to stash cash under your mattress. The main culprits, a stumbling services sector and a sudden slowdown in hiring, two warning lights flashing on the dashboard. So, are we heading for a downturn or just hitting a bump? Let's break down the numbers, the policies, and what it all means for your wallet. The services sector, responsible for over 70% of the US economy, has long been the engine that keeps America running. From bustling restaurants and lively salons to tech support and financial services, this sector touches nearly every part of our daily lives. But lately, the hum of activity has quieted and the warning lights are starting to flash. Just this month, the sector flashed a warning sign that's hard to ignore. The ISM Services Index, a key measure of business activity, dipped below 50 in May. That's the threshold that signals contraction, and it's the first time we've seen this in nearly a year. For many, it's a wake-up call that the momentum is fading. New orders have plunged to their lowest levels since the early days of the pandemic, when uncertainty and fear gripped the nation and businesses shuttered overnight. Backlogs, the cushion of work that keeps businesses busy, are now at a 20-year low, leaving companies with little to fall back on. In plain English, businesses aren't just getting fewer new orders. They're running out of old ones too. The pipeline is drying up, and that's a worrying sign for the months ahead. Meanwhile, the services prices paid index has jumped sharply, echoing the early days of the last inflation surge. Costs for everything from food to cleaning supplies are rising, squeezing already thin margins. Slowing activity plus rising prices, that's the classic recipe for stagflation, a toxic mix that makes it hard for businesses to grow or even survive. So what's behind this sudden slowdown? Tariffs on imported goods and government budget cuts are making companies nervous. Uncertainty about future costs and demand is causing many to hit the brakes. As a result, businesses are pulling back on hiring, putting job seekers on hold and leaving positions unfilled. It's classic economic caution. When the seas get choppy, businesses batten down the hatches, cut costs, and prepare for rough weather ahead. Right now, the outlook is unsettled. Uncertainty is the only thing in abundance, and decision-makers are left guessing what comes next. The services sector is groaning under the weight of these pressures, and the rest of the economy is starting to feel the strain. If this trend continues, the ripple effects could reach far beyond storefronts and service counters, touching every corner of American life. The job market isn't looking much better. In May, private employers added just 37,000 jobs, the weakest gain in 2 years and far below expectations. April's numbers were revised down too, confirming a cooling trend. Businesses, spooked by economic uncertainty and rising costs, are tapping the brakes on hiring. Construction and healthcare are still adding jobs, but most sectors are slowing down. The weak ADP report casts doubt on the upcoming government jobs data. Why the slowdown? Tariffs, higher costs, and a natural post-pandemic hiring plateau all play a role. Companies are waiting for clearer signals before expanding payrolls. The puzzle pieces aren't fitting together, and everyone's getting nervous. Tariffs are back, and they're already shaking things up. The global marketplace is suddenly a lot less predictable, as new trade barriers pop up and old alliances are tested. For businesses that rely on international trade, this means a whole new set of challenges to navigate, and for consumers, it means the effects are about to hit closer to home. The Trump administration doubled tariffs on steel and aluminum to 50%, and legal battles are adding to the chaos. These tariffs are designed to protect American industries, but they also spark retaliation from trading partners, leading to a tit-for-tat escalation that can spiral quickly. Courtrooms are now battlegrounds as companies and governments fight over the legality and impact of these measures. Supply chains are feeling the pinch, with delays and rising costs. Just ask Dollar Tree, which warned of a massive earnings drop due to tariffs. Companies are scrambling to find alternative suppliers, reroute shipments, and absorb higher expenses. The ripple effects are being felt from warehouses to retail shelves, as businesses try to adapt to a rapidly changing landscape. Who pays? Ultimately, consumers, as businesses pass on higher costs. Everyday items from groceries to household goods are getting more expensive. Shoppers are noticing price hikes at the checkout, and families are forced to stretch their budgets even further. About 6% of U.S. imports are now affected, especially autos, steel, and aluminum. These industries are particularly vulnerable, as they depend heavily on global supply chains and imported materials. The impact is visible in showrooms, factories, and ports across the country. Tariffs create uncertainty, forcing companies to rethink supply chains and brace for higher expenses. Business leaders are holding emergency meetings, trying to forecast the next move, while workers on the ground deal with disruptions and shifting priorities. The cost of doing business is rising, and no one is sure when relief will come. This anxiety is spreading, making businesses more cautious and slowing economic activity. Investments are being delayed, hiring freezes are becoming more common, and the overall mood in the business community is one of apprehension. The uncertainty is contagious, affecting decisions at every level. The trade spat is more than headlines, it's hitting wallets and confidence. As families watch their expenses rise and savings shrink, the broader economy feels the strain. In the end, a trade war isn't just about numbers, it's about real people facing real consequences in their everyday lives. If all of this sounds familiar, that's because it is. We've seen a similar story play out not too long ago. Think back to the 2018 to 2019 US-China trade war. Back then, headlines were dominated by escalating tariffs, tense negotiations, and uncertainty rippling through global markets. The world watched as two economic giants squared off, each move on the chessboard sending shockwaves through industries and households alike. Those tariffs did lead to some short-term gains for American steel jobs, offering hope to certain communities, but the benefits were uneven. Downstream industries, like car makers and appliance manufacturers, faced higher costs, and ultimately, tens of thousands of jobs were lost in those sectors. The ripple effects were felt far beyond the factory floor, impacting entire towns and local economies. Today, the new tariffs aren't the only challenge. Lingering inflation continues to squeeze family budgets, while the Federal Reserve's interest rate policies add another layer of complexity. And let's not forget the aftershocks of the pandemic, which have left many businesses still struggling to recover and adapt to a changed world. Tariffs, on top of all this, add more costs and uncertainty. For many businesses, that means putting investment plans on hold and slowing down hiring. The fear of unpredictable expenses makes it harder to plan for the future, and some companies are forced to make tough choices just to stay afloat. The Congressional Budget Office estimates that tariffs could help reduce federal deficits by as much as $3 trillion over the next decade. But the big question remains, at what cost? Slower economic growth and fewer jobs could be the price we pay for shrinking the deficit, raising tough questions for policymakers and the public alike. It's a classic trade-off, less government debt, but potentially higher prices at the checkout counter and fewer job opportunities on Main Street. Small businesses in particular feel the squeeze as they try to balance rising costs with keeping their doors open. The debate over tariffs is as fierce as ever, with strong opinions on both sides. But one thing is clear, the fallout is real, and it's being felt every day by businesses trying to survive and consumers trying to make ends meet. All this turbulence puts the Federal Reserve in a bind. Slowing growth suggests rate cuts, but tariff-driven inflation says not so fast. The Fed may delay cuts, leaving businesses and borrowers stuck with higher rates. Markets are jittery, stocks dropped, Treasury yields fell, and consumer spending is slowing. Watch for the Fed's next move and the upcoming jobs report. Both will signal where we're headed. And keep an eye on tariff news. More changes could mean more economic twists. The next few months will be crucial, so stay tuned. The economic roller coaster isn't over yet. Hang on tight.